In today's video, I'm going to analyze a chart sent by one of the followers called Alexander. He sent a chart that was organized and with clear observations. By the way, most people that sent me charts just emailed random charts and asked me what I think about them. What I was expecting was a chart with detailed observations and good questions. I will analyze Alexander's chart because it was one of the best questions and the one most people will be able to learn from. So this is the chart he sent me. The 45-minute Canadian dollar versus the Japanese yen. He actually numbered the relevant highs and lows, and in the observations that he sent me, he was wondering about which highs and lows belong to the major and minor flow of this market. In my opinion, he made a pretty decent job at identifying the major and minor highs and lows, and in the end, he reached the conclusion that it would be a good idea to buy in the demand zone coming out of number 6 and 6.2. As you can see, high number 7 is higher than high number 5, which makes low number 6 a confirmed low, meaning that there are buyers we could count on in that area. Once again, perfectly valid observation. However, as you can see, the trade he was thinking about failed because those buyers were not able to hold and the demand zone got broken. At this point, he was thinking what he might have done wrong, and the answer is that he didn't do anything wrong. That is perfectly normal. In fact, it happens a lot. Supply and demand zones work sometimes and they fail sometimes also. Even though he didn't do anything wrong with his analysis, he certainly made an incomplete one, which is a different kind of mistake. One thing I would suggest is that he should use more elements in his analysis like divergence and different types of lines. For example, let me go to my chart and show one simple line that was supporting his trade idea. There is an obvious pitchfork we can draw using numbers 5, 6, and 7. With that pitchfork, price makes a small overthrow, and if you know price action volume 1, you know you can compensate that with an underthrow, meaning you can shift the whole pitchfork to match the overthrow, and you see that price lands on his demand zone exactly in the pitchfork line. Or you can adjust the C-axis of the pitchfork and transform it into a width pitchfork, which will produce the exact same effect in this situation. Even though he didn't do anything wrong with the analysis he made, as I said, if he included more elements, he would see that this trade was a bit ambiguous. For example, we can see that there is a bearish reversal divergence in the RSI, suggesting that those buyers he was counting on were not as strong as he thought they were. Momentum analysis is tricky in this one because despite the bearish reversal divergence at the top, at the demand zone he tried to trigger his trade, there was a bullish continuation divergence supporting his analysis. Nonetheless, we have colliding momentum information here. The ambiguous information is a red flag, of course. In terms of volume, we can also see that the 6-7 vector is weak, meaning that there is not much volume to sustain the movement. In other words, volume in number 7 is lower than the volume in number 5, which is a red flag since 7 is higher than 5. That's a volumetric divergence, if you will. That's an indication that those buyers at number 6 are not as strong, even though they were able to surpass number 5. In the email, he also asked what should he do from now on, and then he started listing the next demand zones in a way as if price will continue falling for sure. This is one mistake I see people make all the time. You have to remember to look for both sides of the market at all times. Looking at the next demand zones is certainly valid, but you have to look at the supply zones as well. Notice that when his trade failed, a very good piece of information entered the scene. We now know that there are sellers in control here, and if sellers are in control at this point in time, it doesn't make much sense to look for only 4 demand zones. Notice that number 7 became a solid major high after his trade failed. There is also a solid minor high right at the place where his trade failed. Those are levels you should be paying attention to. What you're going to do if price reaches those levels will depend on several other factors, but this is what we have in this chart at the moment. What you thought would be a demand zone might act as a supply zone, for example. That happens all the time in the market. In my view, there are 3 very important lessons we can take from this. The first is that we must combine several different techniques and only trade the intersection between them. Context must be aligned with technique. That's the ideal. That's probably the most important technical trading principle of all. The second lesson is that the outcomes of your trades are non-deterministic. In other words, doing the right thing will not always guarantee a good outcome because there is always an element of uncertainty in the markets. That's just the nature of trading. If your trade has gone wrong, it doesn't necessarily mean you did something wrong, although that's certainly possible. The third lesson is that as a trader, you should always pay attention to both sides of the market. You must always make the exercise of trying to detect if you are being biased by what you see, which is very common. So thank you very much, Alexander, for this chart. I think this is going to be very helpful for other people. If you want to learn more about these trading techniques, please check out my Price Action Training Volume 1 course in the video description. That's it for this video. If you like the material I produce, please click the like button, subscribe to the channel, activate the notifications button, share the video, and leave your feedback below in the comment section. Thank you very much for watching, and I hope to see you in the next videos. Take care.